March 10th, 2023, Silicon Valley Bank collapses with $212 billion in assets. The biggest U.S. bank failure since 2008. 2 days later, Signature Bank goes down with $110 billion on May 1st. First Republic follows with another $213 billion. In just 60 days, more than $550 billion in bank assets disappear. That speed of collapse hasn't happened since the Great Depression. If this kind of breakdown matters to you, subscribe. And immediately after those failures, the same statements were repeated. The system is sound. Deposits are safe. This is isolated. Those exact words were used in Iceland days before their banking system collapsed in 2008. Cyprus used them 1 week before deposit seizures in 2013. Lebanon used them in 2019, just before accounts were frozen. They are still frozen today. There's a clear pattern in modern banking history. It has played out in multiple countries over the last 15 years. Every time, people believed it couldn't happen where they lived. Every time, they learned the same lesson too late. Money in the bank is not legally yours when the system needs capital. Banking collapses follow a 5-stage sequence. The United States has already passed the first 2 stages. We are now in the third. The same stage Cyprus reached days before depositors lost their money, and Lebanon reached shortly before withdrawals were locked. To understand what happens next, you have to look backward. In the early 2000s, Iceland's banking sector was small. 3 banks held around $15 billion combined. 5 years later, they controlled close to $150 billion, nearly 10 times the country's GDP. This wasn't organic growth. It came from deregulation and unrestricted access to global credit markets. The banks borrowed aggressively using short-term foreign funding, operating at extreme leverage. For every dollar in deposits, more than $8 were loaned out. As long as international credit kept flowing, the system looked stable. Then Lehman Brothers collapsed in September 2008. Credit markets froze. Within a week, all 3 major Icelandic banks failed. Assets vanished, the currency lost half its value, unemployment surged, and capital controls were imposed for years. Warnings existed well before the collapse. International institutions raised concerns, but the expansion was profitable and politically convenient. When the system failed, depositors discovered that their savings were treated as a liability, not protected property. Cyprus followed the same path. By 2010, its banks held deposits worth 8 times the country's GDP. Much of that money was concentrated in Greek government bonds. When Greece's debt crisis hit, those bonds collapsed in value. Losses were hidden until they could no longer be ignored. In March 2013, banks closed overnight. A rescue plan was approved, but with a condition. Instead of taxpayers paying for the losses, depositors would. Deposits above $100,000 were not temporarily frozen. Nearly half were permanently taken and converted into shares of failing banks. Billions were removed from private accounts legally. Cyprus became the real-world test case for modern bail-in policy. Lebanon's collapse was slower, but no different. Banks offered unusually high interest on U.S. dollar deposits, far above global norms. The system relied on constant inflows of new money to pay existing obligations. When inflows stopped in 2019, withdrawals were quietly restricted, then limited, then effectively frozen. Today, those deposits still exist on paper. In reality, they have been destroyed by currency collapse. Depositors have no legal recourse. The central banker who ran the system is now facing international charges. This is how depositor money is taken in the modern system. Not through theft, but through law. Bail-ins replace bailouts. Depositors are classified as unsecured creditors. When a bank fails, their money becomes part of the restructuring. In the United States, this authority already exists. Regulators can seize a failing systemic bank, calculate the losses, and convert uninsured deposits into equity to recapitalize the institution. It happens over a weekend. Markets reopen with balances permanently reduced. This is not speculation. It is written policy. Now look at the present. U.S. banks operate with high leverage. Regional banks hold trillions in commercial real estate exposure that has lost significant value since 2020. Hundreds of billions in losses remain unrealized through accounting treatment. Those losses stay hidden only if deposits remain in place. When withdrawals begin, assets must be sold. When assets are sold, losses become real. When losses exceed capital, the bank fails. Emergency lending in 2023 paused the crisis, but it did not fix insolvency. The math does not work. High leverage and massive hidden losses cannot coexist indefinitely. In past collapses, the time between visible stress and decisive action averaged around 10 days. The warning signs appeared in the United States in early 2023. The sequence has not been broken, only delayed. The question has never been whether this can happen. It already has, again and again. The only unknown is timing. The evidence isn't in predictions, it's in history. We are in stage 3.